Hi, I'm Eddie Sunderji, and welcome to your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. Before we dive into things, don't forget to like and subscribe to our channel. Lots to learn every day. And Jeff's newsletter can be found on Substack at hugeinsights.substack.com. He published his interim bulletin on Sunday night, and we're going to go dig into it right now. So without further ado, Jeff, welcome back. And, always things to talk about. So we're on your interim bulletin today. So why don't we dive in and have a look at the top down?
Absolutely. Well, first of all, thanks a lot for having me on the show today, Eddie, as usual. And, I think a lot of people are focused on the price action Thursday and Friday last week in the S&P 500. We did see an outside up day on Thursday. We did see very good follow through on Friday. But, we did not take out the prior weekly high, although we did hold above the 200-day moving average, which, many people believe to be important. We think it's pretty arbitrary and don't really think it's critical in any way, shape, or form. It's a measure of trend. That's all. The one thing that I would point out is that yesterday's price action, to me, looks like it's possible that the S&P may have topped. There was what's known as a tweezers top on a shorter term intraday basis. We did then put in a bearish engulfing candle, again, on a shorter term basis, but that all kind of plays into the next leg, right? So, we did fall short of filling the gap at 4,079. And, honestly, we've got a couple of counts that we're going to talk about here in a little bit that we think explain the price action. But I do concede that the market may still want to fill that open chart gap at 42.28. That is definitely a possibility. And, we would, keep an open mind about that. We'd also say that, 4,200 is kind of a key level. So, once we press above 4,200, if in fact the market does decide to do that, we're going to have, a decision point. But, the long and the short of it is this. We think T-bills at 5% on a 6-month out basis might very well present the best combination of value, safety, liquidity, and yield. And that's what we're advocating clients focus their attention on right now until the market clarifies which direction it wants to go. We believe that direction will be to the downside, and we're advocating minimizing net equity exposure and maximizing cash reserves at this point.
To the downside. Well, we're definitely keeping a close eye on things. And speaking of eyes, let's have a look at Hedge Eye's cartoon. You've put it in your piece this week, and do you know what? This just makes me chuckle. It really does seem to encapsulate the market sentiment right now. You do include them in your weekly and monthly pieces quite regularly. I like them.
Yeah, they're brilliant, and I do believe that this one does a great job at identifying the key issue, and that is, as we highlighted in our newsletter, Huge Insights, the big picture. The bull case is literally hanging by a thread, and that thread is the 200-day moving average. Okay, many technicians and armchair, chart watchers, and even institutional investors, for that matter, regard the 200-day moving average as something of great importance. We've talked about it many times and debunked it. Its importance is really dating back to a guy named Joe Granville, who, highlighted it as kind of being his mode of identifying trend back in the 60s and 70s. He had a pretty good track record as a timer, and it caught on, right? And so, as long as the market holds above that 200-day moving average, people are going to say we're in a new bull market, right? I think the real significance of the 200-day moving average will be revealed if and when the market breaks below it, because it'll be a massive sell signal for all of those trend followers out there, including billions of dollars in CTAs at this point. I'm hearing upwards of $50 billion is hinging on the 200-day moving average, and a break below it will send all that money to the sidelines. So, we'll see. We talk about the risks extensively in the newsletter. We use kind of the iceberg risk model to kind of, highlight what's going out there in the global macro area. As everybody knows, the vast majority of the size of an iceberg is below sea level. It's not visible to most. And that's the problem. Most of the risks in the market just aren't visible to most of the market participants out there. And some of the risks aren't visible to any of them. The obvious risks, the known knowns, as we kind of dub it in the newsletter, are pretty well, covered in the general media, right? But we've broken, this risk iceberg down into four categories. In addition to the known knowns, we believe we also need to focus on the known unknowns and also the unknown knowns. And then finally, as former Secretary of Defense Donald Rumsfeld so eloquently put it, the unknown unknowns. And so what we spend some time doing in the newsletter, Mehdi, is we try and, number one, identify what those are, or certainly acknowledge them, and examine all of these risks from different perspectives. We cover everything from, a $31 trillion national debt, the rate cycle, the collapse that we've seen in the housing market so far in this bear market, what's happening in, the ISM index from manufacturing new orders perspective, and what the implications are for economic growth. We go into our usual kind of understanding of the yield curve and where rates are going. And we talk a lot about where we see long-term interest rates headed. And then, we dig deeper into earnings and valuations and things of that nature before we finally go into kind of a deep dive on our longer term, intermediate term, and short term market forecast, and then finally our positioning. And so, for those who really want to get, I think a true sense of how we've analyzed the markets, where we see the risks, and how we are positioned, download the newsletter, give it a read. I think it'll be, at the very least, enlightening.
That's a really great recap of what I personally think is, I enjoy to read every week, every month. I think it's a fantastic outlook, very well thought out, and it's always exciting to do a follow-up video and kind of supplement a lot of that reading with just our conversation as well. So, I think
Yeah.
the two work hand in hand together very nicely. Obviously, if you want to learn a little bit more and get more in-depth analysis about it, you've got to read the newsletter. And on that note, Jeff, you touched on it in your opening remarks. Why don't we have a look at some technicals? Let's have a look at some of the short-term levels that you were discussing.
Yeah, well, first of all, let's think about this from a little bit longer perspective. We've got a chart of 3-year weekly view in our deck this week, and that really highlights what we believe is being misinterpreted as a quote unquote inverted head and shoulders bottom formation. I can't tell you how many times I read this on Twitter and various people talking about how, we put this bottom in and it's an inverted head and shoulders. I mean, I've been a technical analyst for quite a long time. I've been in this business for 33 years. And I can tell you that I've never seen an inverted head and shoulders base that looks like that. That to me does not meet the criteria of an inverted head and shoulders base formation. And so it probably isn't. What is more likely is that it's some type of a lateral consolidation pattern, possibly even a triangle formation. And what's typical of those lateral consolidations is they resolve in the direction of the prior trend. Well, the prior trend was down. That trend was down from January of 2022 into mid-October of 2022. And this consolidation probably sets up the next leg to the downside. We've laid out this in no uncertain terms using the Elliott wave principle. And what we've determined is that the initial 5-wave decline off the January 4th, 2022 high really is probably primary wave 1 down of a 5-wave motive wave structure. Okay. And so we saw a big counter trend advance off of the June low that looks to us to be primary wave 2. That peaked in August 16th of last year. And since that time, we've kind of gone sideways, right? And so, we've taken a more magnified view, kind of looking at this on a 5-month basis and kind of breaking down all of the, iterations, the up, down, ebb and flow of the market since August 16th. And what we see is initially the decline into the August, or from August 16th into the October 13th low occurred in about 2 months. And it was 5 waves down at intermediate degree. We think that was intermediate wave 1 down of primary wave 3. Since that time, over almost the last 5 months, we've experienced a choppy, overlapping lateral consolidation that looks most likely in Elliott wave parlance to be a zigzag or a double zigzag, depending how you want to count it. Okay. The simple fact that we've, eclipsed the period of time to the downside by 2.5 times. In other words, 5 months instead of 2 months. And we still haven't taken out the August highs. This tells us that this is very likely a counter trend advance. In fact, the highest probability is that it is a counter trend advance. And more importantly, it's likely topped. And so, we've posited 2 possible alternates, okay? Alternate number 1 looks at the price action since the February 2nd high as being 5 waves down complete, and that's at minor degree of trend. So we're calling it minor wave 1. And the big move up over the last 3 days is probably minor wave 2, okay? And if that's correct, well, we've already retraced about 50% of the decline. It's possible we could retrace 61.8, 2/3, 78.6, or even 100% of the decline before wave 2 is going to terminate. We can't exceed the February 2nd high, though. But let's assume that we're very, very close to seeing, a terminal point in this minor wave 2. If that's the case, we are now at the precipice of a 3rd wave decline at 3 degrees of trend: minor wave, intermediate wave, and also primary degree of trend. And that should be a fairly epic decline if we're correct about that. Now, we've also suggested maybe we're wrong about that. Maybe we haven't completed 5 waves down. And the second alternate that we put out there suggests that, well, since about February 24th, where minute wave 3 bottomed, everything to the right of that is probably minute wave 4, and it's tracing out an expanded flat so that the initial move up is an A. The low that we saw last Thursday is probably the terminal point of a B wave, and everything since Thursday's intraday low is an impulsive wave C advance, and that probably peaked in the way that we would measure it at the 61.8% retracement. And I would suspect if that's the case, we'll start to see, a move down to complete minor wave 1 down, and that would be minute wave 5. And so, that's how we would say it. Now, the point is this particular interpretation would be broken if the S&P exceeded 4,088, at which point we would now have wave 4 entering into wave 1, and that violates one of Elliott's rules, and therefore it would rule this out. So that's basically the technical picture as we see it from, kind of a primary, intermediate, and minor wave perspective.
So technicals to internals, how are the internals looking? They seem to be fading a little bit as well.
I put it this way, they're suboptimal. There's no doubt that, off of Thursday's intraday low, breadth expanded tremendously, right? We had an 89% up volume week last week in S&P 500 volume, that is. It's the best week we've seen in a while. But as good as it was, it didn't come anywhere close to the November peak in volume, up volume. And so, again, suboptimal. I'd also say that, the up-down volume ratio is still only about 2 times. Usually you want to see that at around 4 or 5 times to really suggest you've got some durability. Breadth itself, while I suggested we got a big, broad move on Thursday and Friday last week, and a little bit of follow through yesterday, If you look at the 5-week moving average of net advancing issues, it's still below zero. And so, that's not a good place to be on a weekly closing basis. And then finally, I just say momentum. Momentum's neutral, right? It's above the median line right now, but it just pierced the median line last week, falling, sharply from overbought. And if we take a look at like the two periods that I would compare would be 2021. If you look at momentum throughout 2021, it spent 100% of the time from about January through October above the median line, and most of that was in overbought territory, a good deal of it, right? It wasn't until things started to flag in October that we saw some momentum breakdown. And shortly thereafter, in early November, the NASDAQ peaked, right? And so that was a good indication that something was changing. Throughout 2022, we could see momentum spent most of the time below that median line, right? And quite a bit of that time in oversold territory. And so here we had this big, rapid rally back up into a, brief overbought condition, and then a plunge back below the median line. And now we're just barely above it, right? My suspicion is that this neutral condition is in the process of reasserting itself on the downside, where momentum will remain below the median line and closer to the oversold area as the market begins to show us its true colors. And again, as we've articulated, we believe that will be to the downside.
Well, suboptimal indeed. Let's have a look at some sectors here, Jeff. Last week you did mention that you liked industrials. What do you like at the moment?
Well, there's three that stand out. If we take a look at last week's performance, we saw a lot of follow through in that kind of general industrial sector. It was led by materials. That was the best performing sector last week. Industrials was the second best, putting a couple of back-to-back weeks together. And then of course energy continues to kind of hang in there. And as I said last week, I wouldn't discount the potential for energy to make a pretty good comeback. There's always names to choose from, and we can dig into that if you want to.
Absolutely. And in fact, that's what you did in your interim bulletin this week. You grabbed a couple of these sectors, the three that you mentioned, materials, industrials, and energy, and you've kind of broken them down in a bit more depth, and you're looking at some of the individual names that stand out to you. Are there any you want to jump into in regards to, let's kick off with materials?
Yeah. So with regard to that study, we're really looking at relative strength, okay? And this is relative strength within the group itself. So we already know these groups are leading. We want to know what's leading within the group, right? And so if we look at materials, the standout is Nucor Steel, NUE. Also, Dow Chemical looks quite attractive. Celanese, symbol CE. LyondellBasell, another chemical company, and then Packaging Corp of America. Those are the top five that I would look at within materials right now. They're leading in terms of their sector, and they're leading in terms of their relative strength within the sector. So all in all, those five look like they're standouts.
And, similar exercise on the industrial side?
Yeah, within industrials, I think United Rentals is the standout name. We've been long this stock in our, recommendations for some time. I probably brought it to people's attention, a month and a half, 2 months ago. We also like GE. GE is leading right now. TransDigm, an aerospace company, has also been a long time name that we've been advocating. Parker Hannifin is a new name. It's kind of been on our watch list for a while, but it is breaking out and leading from a relative strength perspective. And then PACCAR, truck manufacturer. This is a name that's kind of been on our buy list for a while. PCAR, and PACCAR would be one of the leaders we'd focus on as well.
Well, Jeff, before we hit the last sector, energy, you said TransDigm. I've always said TransDigm, so I'm really glad to hear that that's how you say it. So TransDigm. But energy, yeah, an on and off loved and hated sector. What are your names in this one?
Well, the standouts are going to be kind of Marathon Petroleum and Valero, but also ExxonMobil continues to be kind of a leader. It's the big name that's made a new all-time high, and I think that you don't want to ignore that. Stocks that are making new all-time highs have very few unhappy shareholders. There's no overhead resistance. There's no supply. Another company, Targa Resources, stands out, and then Diamondback Petroleum, FANG is the symbol there. These are the five that really kind of stand out as relative strength leaders within energy. And again, we're all about focusing on leadership. Stocks that are leading their industry, leading their sector, leading the market, making new highs, new 52-week highs, and if possible, new all-time highs. That is where you want to focus your capital. That is what is going to be the new leadership if, in fact, a bull market or any rally materializes.
So, Jeff, you also every week you have your actionable trade ideas. This week we've just got two longs, which is kind of surprising because I normally find that, especially the way things have been looking in the market, you have at least some strength on the short side. But let's go with the two longs today.
Well, as I mentioned to you offline, we were pretty tired coming into this weekend after all the publications we've done in the last week. So, we actually publish this as an interim bulletin as opposed to our usual weekly playbook. And normally in an interim bulletin, we're not highlighting individual issues, but we couldn't resist. And one of the reasons is, we saw this really compelling interview with David Einhorn on CNBC. And I'm not a big watcher of financial television. Somebody told me about it, and so I decided to tee it up and watch it. And I was really particularly interested in his views on coal. And one of the names that jumped off the page at me as I dug into some of the coal stocks was this Warrior coal, symbol HCC. Einhorn finds a lot of fundamental value in this industry, and this is a name that's really a standout. The stock is breaking out above around the 42 level with a pretty powerful weekly outside weak bar in the candlestick bar. And, that really, to me, looks like, we've got a bunch of things happening here. New all-time high, new 52-week high, powerful candle last week to close things out. And, breaking out of a really, substantial base formation. And so it gives us the ability to count a measured move up to around $58, which is, a nice move for a $42 stock. We protect capital by setting our stop at around $38. And then, the other name is this Builders First. It's a building supply company. BLDR is the symbol. That stock broke out at 85. It made a new all-time high. Weekly closing high as well, with very strong momentum. Again, coming out of a similar structural base formation that gives us the ability to count an upside target to $120 on a measured move basis. We'd set our stop loss at 78 on BLDR and call it a day.
Jeff, as always, well, first of all, I want to say you might not be a fan of watching financial news, but your finance TV should always be on your screen. So, let's not forget that one. I always, love hearing from you, and thank you for sharing your thoughts from Alpha Insights. It's always eye-opening and interesting and worth a view. And I want to urge our viewers to check out Jeff's content on Substack. It's at hugeinsights.substack.com. Jeff, until next time, thank you.
Thank you.
And to our viewers, good luck investing.